Well, this is a follow-up to the video I did last week, and I'm going to do a video on each of the points that I talked about in the market update last week. This one's going to be about cap rates, really understanding what the cap rate is and how we can measure the overvaluedness or undervaluedness of the REIT sector based on cap rates. And cap rates are mean reverting. So they can get to a point where they signal an overbought situation or an overvalued situation, and of course an undervalued situation, and we'll dig through those. And tying this back to the CFA content, level 2 alternative investments, the second reading deals with publicly traded real estate, and in that reading we talk about the direct capitalization method, and that's where the cap rate is introduced. And in level 3, capital market expectations, the second reading for capital market expectations, we look at the relationship of the cap rate with the business cycle and with the building cycle in terms of investment in income producing properties. So let's just, the first couple of screens are really just to get you caught up to speed on exactly what we're talking about when we refer to a cap rate. And then we'll break down the cap rate into its components. And in doing that, we're going to look at a numerator, we're going to look at two components of a denominator, and then we're going to start forecasting those particular things. And we want to do that. We want to break it down to its component parts. Because we can think of the market as a game of chess, masquerading as a game of checkers. For many people, they're playing checkers, and checkers does rely on a certain amount of luck. Whereas with chess, we want to start playing 2, 3, 4 moves ahead, and we want to play that board. We want to position ourselves for where the board is going, not so much for where we are today. And only by breaking it down and looking at the components and thinking deeply about which direction each one of these things are going to go in, can we then come up with a good strategy 2, 3 moves ahead. And then I'll end with what I think is a very low risk strategy to take advantage of REITs that we think are fairly valued. They're not really great. We'd like to have some exposure to them, but we certainly don't want to commit a lot of capital. We want a very convex return, but we don't want to pay for that return. Sounds interesting, right? I'll do that right at the very end, but it's going to be hard to understand the strategy until we see where we're going here. So let's look at cap rates. Our cap rate is calculated as the net operating income of the property, the expected next 12 months net operating income divided by whatever we pay for the property. So if a building is, let's say, $1 million, and we expect that we can generate net operating income on that building of $50,000 over the next year, we're basically buying that building at a cap rate of 5%. The lower the cap rate, the higher the property value that we're paying. The higher the cap rate, the lower property value, or it's since there's a numerator and denominator, it could be the higher the net operating income, but the greater the value that we're getting out of it. To figure out what different REITs are selling at in terms of cap rates, we can look at an implied cap rate. That if we bought the stock at this price, what cap rate are we buying? That is what's called implied. And here our numerator is the last 12 months of net operating income, which we can look up. We can look up their 10Qs, their 10K, and we can see what the last 12 months of net operating income are. We would adjust it for any non-recurring items. So if we have losses on disposal of assets or gain on disposal of assets, we would adjust that out of the last 12 months net operating income. And the denominator is your property value, which is typically the portfolio of properties that you have. And here we have a bit of a problem. If you're using an IFRS reporting company, there will be a category called investment property, and it is reported at fair value. There you go. You have the fair value of the investment property right there. If you're looking at US GAAP, you're going to find historical cost less accumulated depreciation. You're going to find the book value of the properties and not the current market value. So we need the current market value. So the way to get it is just to take the market value of your capital which is the market value of equity, the market value of debt, the market value of preferreds. And for many REITs, they're holding mortgages, or they have mortgages that are non-publicly traded. And you just take the book value of their debt. Most of them will report what a fair market value of their debt is, or if they have publicly traded debt, what the fair value of that debt is. If they don't report their debt on fair value basis, which, probably wouldn't. But they will tell you what the fair value of that debt is. So market value of equity, market value of debt, market value of preferred, less any non-income producing assets. So what you're getting in the end should be the market value of the property. And this is called an implied cap rate. In other words, it is what the cap rate is being implied by the value of the capital in the marketplace. And then we can look at whether we think the implied cap rate is too high or too low. If you're going to use the next 12 months instead of the last 12 months, you will get an expected implied cap rate. And the expected implied cap rate we would expect would be higher than the implied cap rate we would expect, because there would be growth. In normal conditions, we would expect that. We don't know if we're going to get that today. So just so that we understand what the cap rate is, it's basically like a yield on a property, right? So again, I buy a building for $1 million. I can get $50,000 out of it. I'm yielding 5%. I don't want you to think it is a cash yield. I'm just giving you an analogy. You can think of it like that. And we've seen cap rates before. If you go back to level 1 quant, we looked at how we would value a preferred share. We would value it, especially a perpetual preferred share, we value it as a perpetuity. And a perpetuity is simply just the payment that we're getting, the fixed payment that we're getting, divided by whatever required rate of return we want, based on the riskiness of what we were buying. So let's take a preferred share that's going to pay $1.25 a year. And we say, look, based on the risk associated with that and what I could get in other places, what I can get risk-free and the spread that I would like to see, I got to get 5%. I got to realize a 5% return. So if you divide that by 0.05, we find that if we pay $25 for that preferred share, we will realize a 5% rate of return on a stable perpetuity. Property is a growing perpetuity, but we've also seen this before in the Gordon growth model, what a growing perpetuity is. So for property, we would take our net operating income, and of course we want it to be the next period's net operating income. So if this is this period, we multiply by 1 plus G, and we would divide it by R minus G. So this over here is our payment divided by R. This over here is our payment growing divided by R adjusted for growth. That's a Gordon growth model. And that's basically, if you think about property value, if we were going to restate this in terms of property value, what is our property value? Our property value is going to be our net operating income in the next period, T plus 1, divided by R minus G. It's a growing perpetuity. So if you are at level 1 quant and you're looking at all of these things, the perpetuity, a growing perpetuity, and saying, when are we ever going to use this stuff? Here it is. A cap rate is a growing perpetuity. So now that we understand what the cap rate is, and we know how to look for an implied cap rate, I'll show you what happened to Simon Property Group. I calculated their implied cap rate before Pfizer Monday, which is what the market seems to be calling it now, and then a month after. Just so that you have an example. On the next screen, we're going to look at the mean reverting level for cap rates and what it means when it's above or below the mean reverting level. All right, so at the top of the screen right here, I've just recopied what we had on the last screen, but I've restated it for the implied cap rate. Well, not restated, but just stated it in terms of just the implied cap rate. Later on, I will switch it around and I will put property value equals, and you'll find that the implied cap rate becomes the denominator. Our numerator, again, is our last 12 months of net operating income, adjusted for any non-recurring items, divided by the market value of our capital, which should be easy to find. Market value of equity really is just how many shares does the company have and what's the share price. That's it. You just multiply the two. That's market value of equity. The annual report or the quarterly report should tell you the market value of debt. And then for market value preferred, it's simple enough. It's how many shares of preferred stock are out there, how many different classes, and what are the prices of them. Multiply them out, add them up, and subtract any non-income producing assets, which is typically everything except property less accumulated depreciation, because you are doing this for US GAAP. If it's IFRS, you already have that number. So let's look at just a rough graph of cap rates, and these are cap rates along here, and this is just time along the bottom. And there's the 20-year average for all REITs, about 7.1%, and cap rates are mean reverting to a long-term trend. So if we use, in a minute I'll just describe what the 5-year rate would be, because you might say, well, hang on a second here. If you're going 20 years, you're going to have two interest rate regimes in there. You have the pre-Great Financial Crisis interest rate regime, where short rates were as high as 5 and 5.25%. I don't think we're going to see that for a while. That you really should be just using perhaps the last 10 years. Well, this is a 7.1%. That's for all REITs. So when we get a cap rate that's too high, we have REITs that are undervalued. And what this means is that its stock price is less than its net asset value per share. Well, they're selling at a discount. I want to buy things at a discount. When we get a cap rate that is too low, we have a REIT that is overvalued. Its stock price is selling for more than its net asset value per share. It's selling at a premium. And this makes sense. The higher the cap rate we get means the lower the price we're paying. So let's take that building that generates $50,000 in net operating income, and we pay $1 million. That's a 5% cap rate. But what if we can get it for $500,000? That's a 10% cap rate. Well, $500,000 versus $1 million, we're buying it at 50% discount from what would create a 5% cap rate. The lower the price, the higher the cap rate. In other words, the higher the yield that I'm going to realize on that. So really high cap rates signify undervalued properties or extremely distressed properties. So be careful about that value trap. Really low cap rates are a signal about overvaluation. And we can always check if it's overvalued by looking at the net asset value per share and comparing with the stock price and calculating what that premium is. Premiums tend to sell off. Discounts tend to be bid up. They are mean reverting. Let's look at Simon Property Group. And down here for Q1 2018, I went back to 2018. This is these are cap rates before occupancy rates started to rise. From beginning of 2018, for malls, occupancy rates were dropping. Occupancy rates were dropping, which means that if a mall was 98% full, then it was 97, then 96. So vacancy was increasing. So let's go back to Q1 2018, before vacancy rates started to rise. High traffic, let's just look at high traffic malls and high traffic shopping centers. What's the difference? A mall is covered. A shopping center is open. So when you drive into that big parking lot and you see Walmart, you see Best Buy, you see a long strip mall with a whole bunch of clothing stores, maybe Mark's Work warehouses in there, and a few other stores. That's a shopping center. When you drive up to a building and you go into the main concourse and you walk down hallways and there are stores all on the inside, that's a covered mall. And in every city, there are A properties and B properties. A properties are prime locations. That's where all the big tenants are, the anchor tenants are. Those are high traffic malls, or what are called high productivity malls. So if you look at high traffic malls and high traffic shopping centers, cap rates were 6%, 5.9%, roughly 6%. On November 6th, this is the Friday before the Pfizer Monday. Simon Property Group stock price closing gave it an implied cap rate of 5.1%. That Saturday night, Joe Biden gave his acceptance speech, and then Monday, Pfizer announced that it had a vaccine. Wednesday, Moderna said, we have a vaccine and it's even more effective, and Friday, Pfizer said, oh, by the way, ours is just as effective too. We said 90%, but Moderna said 95%. So yeah, we're 95 as well. I thought that was kind of comical. How did you figure that out in 4 or 5 days? But anyways, they're just as good as Moderna. December 11th. Now after that Monday, that Monday morning, the market popped and it just kept on running. December 11th, the implied cap rate on Simon Property Group is 4.02% malls. Okay, we're gonna discuss what's going on with malls shortly. So you went from 5.1% down to 4.02%. At 5.1%, I would say that is probably slightly overvalued. Not a lot overvalued, because SPG is a well-run REIT. So I think that you could probably have cap rates lower than the 6%. 5%, 5.1, once you get to 5.4, 5.5, I'd say it's getting fairly valued, but it ran the 4.02, so that is overvalued. And that's why I was selling REITs, because cap rates got to the point where, okay, even in a great environment, this cap rate is still way too low, and we're not in a great environment. If you will say, well, you know what, you can't compare against a 20-year average. You really got to compare against the last, let's say, the last 5 years or so. This 7.1 goes down to about 6.7 to 6.8. That's for all REITs. These malls are, as of Q1 2018, these are implied cap rates as of that time. So these are probably more reflective of what a fairly valued REIT would be at that time. And again, from Q1 to 2018 to just before, to pre-COVID, from that period of time, vacancy rates were already rising anyways. It might be hard to think back of what life was before COVID, because we've been so impacted by nothing but COVID news. And our lives have been upended by it that we can't really remember what it was like before. But if you think back 12 to 18 months, it was almost every 2-3 weeks, another clothing retailer was saying, we're done, we're wrapped up. Another shoe retailer was saying, we're done, we're wrapped up. And all these places in malls were already shutting down. So when you get a national chain of yet another clothing store that looks like it's selling the same stuff that everyone else is selling, when you walk into a mall and you have 47 clothing stores out of 65 stores, maybe the sector's saturated, right? You knew there'd be some deaths there, but that was going on. That was already happening in malls across the United States, across North America, really. Even in Canada, we had chains that were just shutting down. That's as far as we go. And these were in good times. Retail needs cash flow. So this next round of COVID to maybe the second quarter of next year is going to hurt more retailers. We had already been heading in that direction. To suddenly have a cap rate of 4.02% after a share issuance, and this is Simon Property, after announcing a share issuance to buy Taubman, which is a bunch of covered malls, higher end malls, but covered malls, even at a lower price, $43 a share instead of the 52, that still should weigh on the cap rate, but it didn't. I think this just had to do with a lot of algos. When you have a big news event like this and positive stuff, algos flip. So they buy stuff they were selling and they sell stuff they were buying. So you saw all the COVID related stocks kind of pull back a bit, and all the, let's call it garbage, just went up anyways. Well, take your money when it goes up, and that's what I did. I saw these things go up. I saw cap rates get to the point that go, well, look, the cap rate is so low, where can we go right now? Really nowhere. All we can do is wait for net operating income to catch up with this. Well, I'm already here. The stock price is already here. What do I want to wait for? I'm done. Let's move on. All right, let's look at how we are going to forecast this asset class. And within the asset class of REITs, you have a bunch of different types of REITs. So I'm going to try my best to differentiate between the type of REITs, but let's just really focus on retail for now, because the argument I'm making is retail is something you just want to avoid at this point. And then we'll talk about things that I think are fairly priced. And then we'll end with apartments, and we'll look at some vacancy rates and what the issue with these vacancy rates are. At the top over here, all I've done is I've rearranged what we were looking at before. Rather than cap rate equaling net operating income divided by our property value, I've isolated property value on this side so that we get net operating income for the next 12 months divided by our cap rate. And our cap rate is really just R minus G. So there are three things we're going to look at. We're going to look at the trend in net operating income, we're going to look at the G, and we're going to look at the R. Because if we're going to look at the prospects for this asset class, it's not enough to have a story. Oh, no one's going back to the office and that's going to be it. Everyone's going to work from home, sell, sell, sell. Well, there are three parts to this story. Same with malls. There are three parts to this story. That's where the game of chess is. This is not a game of checkers where we just say, here's a good story, here we go, and maybe I get lucky. It's a game of skill. And you have to start seeing the market as a game of chess. Even if everyone else is playing checkers, just ignore it. You want to play chess. If we're going to play chess, we need to know what the pieces are and how these pieces move. And we have three pieces in this game. We have net operating income, we have a payment for risk, and we have some compensation for growth. And by isolating this over to this side, really the only thing that's really going to change very much, the most variable component, the most volatile component here is going to be the market value of equity, because market value of debt will stay fairly constant, especially if they're mortgages. Market value of preferreds have a stated yield. They tend to have a fairly stable market value of wealth. And the non-income producing assets, this is all balance sheet related, lower volatility on balance sheet assets. So market value of equity really is going to be the one that absorbs all of the gains and all of the losses, depending on what we think is going to happen here. So let's look at net operating income for the next 12 months, and let's just make the assumption for now, and we'll talk about it shortly, but we'll make the assumption for now that net operating income last year is where we're going to start, and we're going to determine what the growth in net operating income is for next year. So we're not going to forecast net operating income components, we're just going to forecast the growth. The growth could be positive, which means net operating income will be higher. It could be flat, or it could be negative. So let's look at some reality here, at some facts. Occupancy rates. This is how much of the building, and we're talking about malls, how much of the mall is rented. The occupancy rates have been dropping since Q1 of 2018. They have been dropping pre-COVID. So it's not as if they're suddenly going to turn around because of COVID and suddenly get great. A lot of retailers are not going to reopen. We look at Canada. Hudson's Bay has been a staple of retail for 150 years. They're being evicted by some malls for non-payment. They're being evicted, and Hudson's Bay is saying, look, the history of or the future of our store is going to be in smaller centers, because what COVID has done is it's had a massive bump on behavior. To change behavior, you need either long periods of time, or you need a massive change in how they can do things sustained for a shorter period of time, and that creates habit. For example, going to the gym. Most New Year's resolutions fail by going to the gym because after 2-3 weeks it sort of just fades away. Research shows that you need 66 days to form a habit. So buying something online here and there doesn't form a habit, but having to do that for 66 days straight suddenly forms the habit. Then it becomes hard to break. To break that habit, to break a habit, research shows you need 99 days to completely break a habit. So if you're going to the gym in the new year, you got to give it till at least mid-March before you really start to feel that addiction. Don't quit before then. That's what everyone does. It's 66 days to form a habit. Well, a lot of people have gotten comfortable with ordering online that they might have 3-4 years from now said, well, the trend is moving towards buying online. Now they're willing to buy much more online than they were before. Less need for retail, less need for the size of retail. I do think retail will be significantly different post-COVID than pre-COVID, which means malls are going to have to figure out how to become entertainment centers even more than they already have been. So malls that are not entertainment centers, I don't know so much that they have any reason for existence. Even smaller retailers have learned to move online, have survived with curbside pickup, where you call in your order and it's available for curbside pickup. So with that, with that in mind, maybe you don't need to be in a place where there's a lot of foot traffic. You're not going to pay $65 a square foot because you have traffic. The traffic is not on the malls anymore. The traffic is on the internet, and I got to be in a high traffic place on the internet. So anyways, occupancy rates were dropping. I expect them to continue to drop. it's not as if every retailer that is in existence right now today in the third quarter of 2021 will still be in existence. This next period of COVID, until we get the vaccine out, there are lockdowns and shutdowns. It is going to affect quite a few retailers. They are going to scale down, or some just completely disappear. So occupancy rates are going to drop. That's a headwind towards growth for the REIT. Demand is going to drop as well. There aren't going to be that many retailers saying, well, we have 50 locations, we want 100 locations, we want 200 locations now, so that's going to drop. Tenant improvement allowances. If you have high vacancy rates, you're going to have some kind of incentive to bring in new retailers. And it's a buyer's market at that point. It's a renter's market. If I want to walk into a mall and I can walk through your mall and I can see that you got 11 empty units and I want one of them, I'm negotiating leasehold improvements that you're picking up, or I'm negotiating 6 months rent-free on a 5-year lease because I'm going to spend so much in improving the store or that unit for my purposes. Leasehold improvements are always the retailer's problem. In a tight retail market, you take what you can get and you do the leasehold improvements. Well, if it's a renter's market, you're going to pay for the leasehold improvements, or I'm going to get a rent abatement. So they're going to get more aggressive with tenant improvement allowances, and you're going to have rent roll downs. And a rent roll down is, with all the tenants you have across all your malls, typically about 15% of your leases will be up for renewal each year. And that's called the rent roll. Can you roll those rents higher, the same, or lower? Well, there's going to be rent roll downs because you're going to lose some of those tenants after 5 years. They might satisfy their lease. You're going to get new ones in. You're going to have to give them some kind of gifts or some kind of compensation for coming in. Maybe you can't raise that rent. You got to keep it flat or lower it. For existing retailers saying, look, we have 50 locations. Maybe we only need 40, unless, of course, we can negotiate something with the rent. And you take a national retailer, typically with one organization or one REIT, one mall REIT, they might be represented in 40 or 50 of their properties. So it's not as if one lease in one mall will go down. It's across 40 or 50 properties. Instead of having this kind of growth, now you have flatter growth, maybe even negative growth, because an empty space gets you nothing. Much like an empty hotel room is lost. An empty space is lost. You may as well keep them. You may as well get something. So I do expect rent roll downs to increase, tenant improvement allowances to increase, demand is going to be lower, and occupancy rates are going to be lower. Well, what does that do for growth? Right? And if we're paying for future growth and growth is going to be under pressure for a while, I can see G being 0 to... You might have, again, 15% of leases would roll over each year, which means 85% stay in place. But those leases may have had natural escalators in the lease, which means that this year over last year, there might have been a natural rent increase that would have happened anyways that was already in the lease. If they don't have to renegotiate any of those escalators, they might have positive growth from the 85% installed base if they don't lose any of them to evictions and just business failures, but let's say that's 75%. But the rest of it, either you're going to have a 0 component or a negative G on that. So if you weight that, I think you get closer to 0, let's say flat growth to slightly negative growth, from anywhere from 3 to 4%, 2.9 to 3.9. I think I've seen as high as 4.1 NOI growth year over year. So I think you're going to take a hit. And that's just for G. So let's just look at the effect that G could have. We'll just take an example and we'll say, well, okay, well, if growth just drops off, so what? I mean, can't we live with that? Let's say that we have a building that has net operating income or properties. Our portfolio of properties generates net operating income of 10 million. And we have growth in net operating income of 3%, which is fairly okay. That's you see 2.8 to 3.9 to 4%. That's fairly okay. So let's say we have growth of 3%, and our required rate of return, our cost of capital is 8%. So our numerator is our next period net operating income. So we'll take the 10 million growth by 3% and discount it by the cap rate, which is R minus G. And we get to 206 million. And that's at 3%. Now let's just change growth from 3% to 2%. That's all we're going to do is change it to 2%. Well, if you have lower growth, R minus G is your cap rate, you're clearly going to have a higher cap rate if you have lower growth. You're going to have a lower denominator than you would because it's only going to grow at 2%, not 3%. And your cap rate is higher. You get to 170,000. 170 million. 170,000. Let's put an M there. You get to 170 million. So what happened here is you had a negative 17%, 17.5% drop in property value. And if we say property value is proxied by all of this, and that the market value of equity really is the variable component that will absorb all of that, you can see a 17.5% drop in the market value of equity for this hypothetical REIT that was able to generate 10 million. Now you can say, well, listen, you went from 10 million to 10,200,000. Your income went up, but your stock price went down. Yes, because growth was lower, and the property is the present value of a growing perpetuity. Well, if that perpetuity is going to grow at a lower rate, it's a lower property value. Now, I did all that without ever changing R. I left R at 8%, saying even though growth is going to be lower, let's assume the market doesn't see any increased uncertainty, any increased risk in this. That's not a viable assumption. Take it a step further. Let's say that G equals 0. In other words, it's not going to lose money. It's still going to make the same 10 million next year, but growth is going to be 0. If you redo this calculation, you'll get to a property value of 125 million. 125 million, which is a 40% drop. You're about 60.68. So if this was a $100 share, and G went from 3% to 2%, you can expect the stock to be selling for $82.50. If G goes to 0 and we have flat growth, and remember all these headwinds here, you get flat growth, that pre-COVID price of $100 is fairly priced at $60. If we assume G is 0, again, we've assumed net operating income will stay constant at 10 million and not drop. We've assumed that risk will stay constant at 8% and not increase. We've just changed G. Now start to change everything else. Now assume lower net operating income, which, by the way, REITs have been reporting since 2018, late 2017, early 2018. Many REITs have been reporting lower and lower net operating income year over year. There have been negative growth in net operating income. So when you combine a lower numerator, this was still the same or higher. Lower numerator, lower G, even a negative G, because if you have a lower numerator, you got a negative G. Larger denominator, we're not talking about $100 going to $60. You're talking about 100 going to 50, even 40, maybe even 30 for not well-run mall REITs. This also spills over to other REITs as well. For occupancy rates, I looked at some of the better residential REITs, and I like Avalon Bay. Avalon Bay, I think, is very nice. AVB, and I was buying this in the 135 to 140 range before that massive run up, and I think I got $42, $43 gain in a period of 3-4 days. Well, you take that, right? Anyways, if we look at year over year, Q3 year over year, 2019 to 2020, last year their occupancy rate, I have it on the screen here, 96%. Now it's 93%. They have roughly 90,000 rental properties, 90,000 specific single-family rental units, 7% vacancy. 7 times 90,000, 6,300 empty units. 6,300. Think about that you're sitting on 6,300 empty units not generating revenue, but generating a cost because there's a property tax that has to be paid. Combine that with apartments. Let's say that you have a building with 100 units in there. Every month you'll expect 3 to 4 of those units to turn over out of 100. Every month, 3 to 4. And now I'm going to expand that to the year, and you're going to find this very shocking. If you have 3 to 4, that's 3 to 4% a month. That's somewhere between 40 and 50% of your building turns over every year. Every year you got to turn over 40 to 50% of your building. It sounds like a lot, right? But when you think about it a month, you think about an apartment building with 100 units, you go 3 or 4 moving out every month. Yeah, that seems about right. That's called a turnover rate, the percentage that turns over per year. The turnover rate for apartments is 40 to 50%. Beyond the turnover rate, you have a turnover cost. How much does it cost to turn over an apartment? Typical estimates are about $1,000 to turn over an apartment, up to $3,000. Some companies some REITs will spend up to $13,000, $14,000 because they're taking that unit, they're significantly improving it to get that real increase in the rent, that positive rent roll, and the ROI on that rent roll is usually fairly high on the incremental amount. The turnover period is the amount of time from the time that it's empty to the time that it's full. For apartment buildings, I think you're going to see for turnovers, I don't know that the turnover rate will increase, but the turnover term will increase. I don't know that the turnover cost will either, but that time that it's empty will begin to increase. So even for apartment buildings, even for something as good as Avalon Bay, at 7% occupancy, you got 6,300 empty units. There are other apartment REITs out there, all in the same place. Well, if 7% of the market is empty, demand could increase, and you still have plenty of capacity to meet that. So you're not going to have pressure on rents going up. So rent rolls there will still either be flat to slightly negative. I'll talk more about that as we go forward. But let's look at R right now. How do we figure out what R is? Well, the nice thing about REITs is they always issue shares, and they tend to issue shares when they are overvalued. And where are REITs right now? At least I believe, with cap rates so low, overvalued. So I think the big threat is dilution of current ownership with, I think, more and more REITs will be doing equity issuances in the next couple of quarters. From there, we can figure out R. Right, let's look at the effective share issuance and how we calculate what our cost of equity capital is here. Again, I've isolated this to one side. Here's the market value of your capital less your non-income producing assets, which is a proxy for the property value of a REIT. Is your net operating income for your next 12 months divided by your cap rate, which is R minus G, and we're looking at the R component here, which is our cost of equity capital. When a company does a share issuance, they'll do it at a particular price. Well, that is, from that price of that stock, we can figure out what the cost of that equity was based on what the company was producing, and if you're selling equity for that much, that was the cost of that equity. So we can look at our funds from operations per share. This is your next 12 months. And sometimes when a company does a share issuance, they'll tell you what the share issuance is for. They'll say this is to buy a particular property, which will be financed so much with equity, so much with debt. And sometimes they'll also tell you it is accretive to funds from operations by this much per share. They'll tell you what the accretion is. So if you know what the growth rate in FFO is, and let's say that it was going to be flat year over year, you could take the last 12 months FFO and just add the accretion on to get what the next 12 months FFO is. And then you would divide it by the share price of the issuance. So a good example was a Canadian REIT that was in the mid-14s, did an equity issuance, and I think they did it at $13.50. So you would forecast what their next 12 months FFO would be. You divide it by the $13.50 and you'd get the implied cost of equity capital at which they did that share issuance. So there is how we would find our R. G requires you to, use some logic and think and say, well, what do I think it's going to be? What are the headwinds? And going with a negative G is rough sometimes, but putting a 0 in or something less than what it was in the past makes a lot of sense. For our purposes, we don't need to come up with a number. We just need to come up with a direction. What's going to happen to G? G is going to be lower. What's going to happen to R? I think R is going to be slightly higher because I, as an investor in this space now coming in, would say, you're challenged. You want me to buy an equity issuance for malls. Malls are in a rough shape. I'm certainly not going to pay that price. I'm going to pay a lower price. And the lower price that I pay for the new issuance, the higher the cost of equity. So I'm not willing to pay an implied cap rate of 5% on shopping malls. I might say, well, listen, we're looking at 8 or 9%. I certainly want to buy it at a discount. I've got cash. You don't, because you got to pay out so much of your cash flow in dividends to maintain your REIT status. You don't have enough to reinvest, and you got mortgages due, and you got some principal payments looming. So you need me more than I need you. So I think R is going to increase. You get R increasing, you get G decreasing, your denominator is increasing. I think your numerator is either flat or decreasing across most REITs. Market value of equity can only go down. So just with quick deconstruction of property values into the component parts, again, I can come up with the general direction in which I think equity is going to head. What's next here? I'm going to show you a ranking of different types of REITs. I'm going to classify them into different categories, A, B, and C, and then give you my idea of where I think each of these are going to become attractive. Okay, so I have a listing of different types of REITs down here from the worst or the most unattractive to, I'm not going to say the best, but the least unattractive. I'm still not, bullish on, and I've classified them A, Bs, and Cs, group A, B, and C. I'm bearish on C, but not to the point that I would short. I see significant underperformance in C, even negative performance. For B, not yet. I think that they're still under pressure. I think there's still going to be some price pullback in section B, but I do see some point at which they become attractive. And A, I think there's some opportunity there, but fairly valued opportunity that I think you have to be selective on. This over here, by the way, is if you're looking for more information on REITs or the state of the commercial real estate industry, some small studies or good data. Center Square Investment Management, NAREIT, National Association of Real Estate Investment Trusts.com, and CBRE.com. They all have subscription sides, but they have free sides, and the free side has, you can get what you get on the free side. There's still some good information there. So we have cell towers or cellular towers, data centers, storage. This is self-storage, warehouse and apartments, followed by, in Class B, industrials and office. Industrial holds up fairly well. Office, I think the whole story about work from home is massively overblown. In one survey that I saw, most office companies, or most companies that have office space, have reported productivity down anywhere from 22 to 24%. And the first survey, I think, was done in June, and then another one in November. And there'd been, June was like negative 22%, November was like negative 23%. So they're saying, look, it doesn't work. For the employee, for those of you out there saying, but I love working at home. Yeah, no kidding. You have semi-part-time hours with full-time pay. What's not to like? Productivity is down, which is saying that, your home is not an office. It's not a productive place to be. There are far too many distractions. You're far too comfortable, and there's no surveillance. There's nobody watching you. There's no leading by example. You're flipping through the TV channel while you're having lunch, and you catch something. Maybe you decide, well, 1 o'clock, I'm not going to head back to the kitchen table where my computer is. I'll finish this up. It's 1:45. Nobody noticed. Nobody noticed that I watched that. I got away with it, and that's your new lifestyle now. Great. Also, for those of you out there that say, oh, no, I work just as hard as home. Don't worry. I can do my job from home with no loss of productivity, and I can prove it to my employer. Be careful about that. If you can prove to your employer that you can do your job remotely, what do they need you for? What do they need the high-paying big city employee if they can move your job to a smaller city? Hey, If you're not coming into the office, what does it matter where you are? We'll pay small city wages. And, why stop at small city wages? Why not pay in another country? If you're showing me that you can do your job from home, then your job can be done from home. It's not that you can do it from home. You've demonstrated that your job can be done from home. What do I need you for? So be careful how much you want to demonstrate to your boss that you can do your job from home, because your boss is not stupid. Will say, well, thank you. That's interesting. If that's the case, how do we squeeze costs out of the system? We don't need to pay New York City wages. We can pay St. Louis wages. In fact, we don't need to pay St. Louis wages if we can pay Bombay wages, right? So anyways, there we go. Where we leave office. Yeah, I think office is overblown. That same survey that I saw showed that the majority expect that 100% of their employees will be back in the office after the vaccine has been widely distributed, and that there is a 30% probability that existing tenants will want more space. So I do see office as going through a temporary hiccup right now. More long-term shopping centers, malls, healthcare. When I say healthcare, this is assisted living or senior living. It is going to be overrun with regulation after what we've seen, after all the deaths in these centers, after the mismanagement that was uncovered in a lot of these, at least in Canadian ones. It is going to be overrun with regulation, which is going to raise costs. And those facilities are some of these healthcare providers are not going to continue to make it. I think many more of these are going to be sitting empty, or that better rents are going to have to be negotiated, simply because my operating costs as my business in your facility has just increased dramatically. I can't pay this rent. We can't justify this rent for this property any longer. So I think that's under a lot of problems. Hotels, casinos. I don't think it's a matter of, great, I got the vaccine, I'm heading to the casino. I think it's going to take a while for people to slowly come back together. So vaccine out by end of second quarter, mid third quarter. Let's call it end of third quarter. Maybe a quarter to forget all about it and start to get back into our habits. So by Q1 of 2022, I think, we'd start to be back into where we are. So I would be selective. By the way, for apartments, you have to make a distinction between gateway cities and secondary cities on this one. Gateway cities are vacancy rates have been increasing dramatically. Gateway cities are big cities as opposed to the smaller cities. So for Canada, for example, Toronto would be considered a gateway city, whereas where I am, St. Catharines would be considered a secondary, even a third tier city. Two big reasons for the big cities being hit. Number one, big cities usually have a critical mass of higher education, colleges and universities. So you tend to have tens of thousands of students coming into that city every single year. And the tens of thousands of students in the city that leave to go to other colleges tend to already be living at home, and they're going somewhere else to rent apartments. Without in-class classes, you don't have all those students coming into the city. So September, October, November, December, coming up with January, February, next semester, that's a write-off. You're not going to have that big mass of students coming into the city. Not until we get into August of 2021, when most colleges and universities will say, okay, now we're back online. Now everybody shows up again. Then I think demand for apartments in those cities will rebound because of student presence. The second big one is immigration. Large cities tend to be anchors for immigration. So in Canada, there are three big cities for immigration: Vancouver, Toronto, and Montreal, that tend to draw most of the immigration. So we look at Pearson International Airport, which is in Toronto, and about 1,000 new immigrants every week land at Pearson. Well, they need to live somewhere. That's apartment rental. Immigration's down 40%. So think about the demand that's taken off the market by lowering those levels of immigration and those students. Students, I think, August, September, there you go. Especially August, because you got to get your apartment rented for September. Immigration, I think sometime in the third quarter or fourth quarter, we'll start to see the levels increase, but I think it'll be a year before it normalizes to where it was before. depending on the political climate. Canada's already said, our Trudeau government's already said it's going to increase the level of immigration, which is a positive for apartments, especially in these big cities like Montreal, Toronto, Vancouver. So I think apartments are in a nice spot right now. High occupancy rates, which means there's going to be some concessions on rent. I think you're going to see many of them offer 11 months of rent for a 1-year lease. So you'll get 12 months for 11 months of rent. There'll be the rent rolls will either be flat or maybe even negative, depending on the turnover rate. And again, 40 to 50% of a building will turn over every year. Well, if you're turning over 40 to 50%, not 15% like you would expect with offices and malls, right around 10 or 15% per year, but 40 to 50%, that's going to be sort of the canary in the coal mine. We're going to see exactly what the rent rolls are there. We would expect it would be the most favorable there. Everything else would be lower. So we'll find out. And again, I want to point out for offices, shopping malls, shopping centers, and malls, vacancy rates were already rising pre-COVID. I think for Category B, Q3 or Q4 of 2021 is a nice place to start looking around for those that are trading at higher cap rates. And malls, I wouldn't be looking at that until mid or late 2022. So like almost 2 years, I would be away from malls. All right, I know this is a busy screen, but we're going to break it down into different cells. Let's just look at this first cell, number 1. Then we'll move over here to number 2. Then we'll move down here to number 3. So number 1, here's the trade. Avalon Bay, December 2021. I'm going to do it with options. I'm going to buy the $165 call. Avalon Bay right now is at 162. Well, it closed Friday at 162.36. I'm going to buy the very next call at 165, and I'm going to finance it by selling the $195 call because I don't see it getting much above 195 for a while. I think it's going to be we'll start to see recovery during 2021. I think August, September, third quarter will probably be good. The forecast will be good. But I don't see it getting much above the 195 until we get well into 2022. So I don't mind selling the 195 call. That's still going to cost me money. By the way, that's called a bull spread. If I'm buying the 165 call and selling the 195 call, I got a bull spread. I'm going to finance it with an out-of-the-money put. I'm going to sell a 135 put. This is negative 170, which means if I put one of these on, this is called a combo. If I put one of these on, I will get $1.70 per option, since all options are for 100 shares. Sorry, I get $1.70 per share. All options are for 100 shares. I will get $170 less, of course, transaction costs. This will cost $3.75 to put on, $125 per option contract. So I'll get $167.25 today for putting this option on. My margin on here is $4,000, so I'll have to have securities or cash in my account totaling $4,000 to put one combo on. That's one 165 call, one 195 call, and one 135 call. So I'm going to talk about the payoff per combo. You might do 5 combos, 10, 20, 30, whatever the case is, but here is the trade. And here is, I'll give you a quick logic is I'm not worried about volatility on this one. I'm not going to wait until there's a sell-off and with higher volatility. Reason is I'm long and I'm short volatility. So I'm neutral on volatility. So volatility is volatile. My position value on its own will be fairly flat. In other words, I'll have low volatility in my portfolio, even if there's high volatility in the underlying and volatility in volatility, only because I'm long and short vol at the same time. At 135, I was collecting it at 135 to 140 because after, before knowing there was a vaccine and a decisive victory, before knowing that, I was comfortable at 135, 140. Knowing it, I'm even more comfortable at 135 to 140. So I'll sell the 135 put, which is even lower than I was before. And I got a $30 run in front of me, 165 to 195. So I've drawn out a sort of a payoff line here. Here's 135, here's 165, here's 195. Between 135 and 165, remember now, I get $170 for putting this position in. So I make $170 no matter what. So if the stock price stays in between 135 and 165, my ROI is 4.25%. I make 4.25%. Which is like buying a preferred share for $25 that never moves but pays $4.25, or buying a one-year bond that pays $4 that has a coupon of 4.25. That's not bad. I get $4.25. Anything between 165 and 195, I get dollar for dollar. But remember, I also got the 170. So if it ends at 195, since that's a $30 spread, I'd make $3,000 on one contract plus the 170 I got. That is a 79.25% ROI, because I consider my investment my margin. I got to have that in there anyways. So that's a 79.25% return. If Avalon Bay goes above 195, I've maxed out at 79.25%. By the way, if I bought the stock at 162.36, if I bought it and I sold it at 195, that would be about a 20% return. By using the combo, I got an almost 80% return, 4 times better on the return. Now we're going to look at the payoff chart down here to see that I will do better on the way up and I will do better on the way down. That's convexity. At 135, actually, let's talk about this number right here, 170, 130. Avalon Bay at 170, 130, considering the move from $65 to 71.30 and the fact that I got to keep $1.70, that gives me 20% ROI. So if my target ROI is 20% a year, Avalon Bay just has to get to 170, 130 over the next year. That's $9 higher. It just has to go up $9. And I make 20% ROI on this strategy. That's what I love about it. Go all the way to 135. Anything below 135, it's going to be put to me. But remember, I got $1.70 a share. So what's my cost going to be? 133.30. My break even on this trade is 133.30. Then I have 4.25% return between 135 and 165, and then I participate in the upside. Anything above 195, I make my full 80% ROI. And that's really what it's all about, right? Is your return on your investment. Not the return, not how many dollars you made, but the percentage that you made on your investment. Here's the payoff chart. This white line is owning the stock itself. So I wrote AVB. You have a linear payoff. It's linear. Goes up $1, you buy 100 shares, it goes up $1, you make 100. Goes up $2, you make 200, etc. But you also lose on the way down. The green line is the payoff for the combo. At 195, you're not going to make any more money because you've sold the call at 195. But from 165 to 195, you participate the same way that a shareholder of AVB would participate. But this line over here, that represents a positive 170. Below 165, you're going to make 170. Meanwhile, the AVB shareholder would lose. There's 135. At 135, you start giving money back. This number right here, by the way, at $135. If AVB finishes right at $135 by using the combo, you still made $170. But a shareholder of AVB has lost $2,736. Heads I win, tails I win. Heads I win because if it goes up, I make a higher return on equity than owning the native underlying. Tails I win because if it goes down, I'll either get a 4.25% positive return, or I get to buy it where I would buy it anyways. I don't lose. If you look at the payoff in terms of ROI, this top line, this is the combo. Let me see if I can get drawing on there. That's the combo. That's owning the stock. So you can see what your ROI, the difference between your ROI looks like. So as the stock price keeps going up, notice what happens to my ROI. My ROI gets bigger and bigger and bigger. That's convexity. Convexity for a very low price. So For category A, for apartment buildings, warehouses, storage, things like this, I am going to look to take neutral positions. When I say neutral, I mean that I'm neutral on it. I'm neither bullish nor bearish. I'm neutral, but can I set up a combo? And if I can set up a combo, then the convexity payoff is so much more attractive, because if it did fall in price, I'd be willing to buy it. I don't think I'm going to do this for offices or industrial REITs until Q3 of 2021. I don't mind missing the first part of the run. I want to see that there's something there. Shopping centers, I am going to avoid like the plague, because while they had a nice bounce and while you have this reopening story going on, not everyone's going to reopen. That's just the reality of it. And businesses, lots of retail, were already closing up before this even happened. It's not as if this is suddenly going to reverse that trend. One more screen to show you if you are a more professional investor investing on a more relative basis. Okay, so this screen is if you sort of have an asset allocation. You say, well, I'm going to dedicate 10% to REITs. I don't think that way, really. I buy what I like to buy, and that's it. So I don't really work on allocations that way. But let's say that you're going to have a 10% allocation and you are going to favor residential REITs. That is your absolute trade. You have a 10% exposure to the residential sector. A way to improve that on a relative basis is to add another 5%. Go to a 15% allocation, but take a 5% short on the retail sector. You still have the 10% long, and what you're betting here is on this relative trade, you're betting that residential outperforms retail. So the net effect is you still have a 10% allocation to residential real estate, but you have what's called a long extension. And you've decided to take your 10 and extend it to 15, but offset the REIT exposure by being short 5% on retail. The first 10% on residential, you're making a long bet on price appreciation. The second 5% combined with the short percent, you're making the bet that all you're betting is that residential outperforms retail. So even if retail goes up, you're betting that residential will outperform retail. You still have a net 10% allocation, but you've implemented a long extension on this one. For a lot of long-only managers, they may have the ability to take short positions, but they may not have the expertise to take short positions. They will typically buy a dedicated short hedge fund, or add allocation to a dedicated short hedge fund. It's not so much that when you add an allocation to a dedicated short that you're making a bet that all the positions will drop, that the short fund will then suddenly return a positive return. It's okay for the short fund you invest in to give you a negative return. What the short allocation does is allow you to extend your long positions. So if you say, look, I'm limited to a 10% allocation to this asset class, although I'd like to go 15%, you can get there by taking a short fund, putting it on in your allocation, and that short fund allows you to extend your long so that your exposure to the sector, your net, is still just 10%. So if you're interested in things like that, there you go. That's sort of how that plays out. For the average retail trader, it's not really a thing. I think it's more important to pick where you want to be, if you're more creative, you can do what I've shown you on the last screen, which is using a combo. If you don't like using combos, or you have a broker that says, oh, we don't allow all of that kind of stuff to happen, you're with the wrong broker. I strongly recommend Interactive Brokers. Not the best for customer service, I'll tell you that right there. You'll wonder why you stay with them when you have to go through customer service. You say, why do I stay with these people? But in one account, you have every security that you could ever want globally on any exchange anywhere. You have everything all in one account, which allows you to do a lot of these interesting strategies. Anyways, it's been, I think we're over an hour. Sorry for taking up so much time. I could go on for another 3 hours on diving even deeper into how to read the financial statements of REITs. Where do we find this information? How do we analyze this? How do we project things for it? That would be a whole course. I really just wanted to give you a high-level view on how we can think about where REITs would be going by breaking down the story into three component parts. The numerator, which is our net operating income, the denominator, which is our cost of our equity, and our growth assumptions in there. And we want to start playing chess. Let everyone else play checkers. We want to play chess. And I think I've given you a good foundation for playing chess here. Anyways, let's wrap it there.